Today's webinar is going to be regarding California residents. Should I stay or should I go? Joining me here today is Francis Ellington and David Saccarellos. And before we get to that, I just want to make sure that the disclaimer is taken into account. Today is March 24th, 2021. So our information we're sharing today is current as of today. Please make sure you talk to your own advisor should you take any action or have any circumstances you need to work with. Everyone's situation is very, very unique. I also want to make sure that it's clear that for today, we're going to be focusing exclusively on personal income tax. We're not going to be spending much or any time really on business or other entities. So without further ado, I'd like to introduce Francis and David. Francis is the state and local tax practice leader at GHJ with a focus on multi-state income and franchise tax. She also works with indirect tax, tax credits and incentives, and she has more than 10 years of experience in this arena. She's also received several accolades, one of them being named one of the 2020 Young Accountant of the Year by the Accountants and International Accounting Bulletin. And CalCPA in 2019 named her a woman to watch. David Saccarellos is a veteran tax partner at Seiler, and he has over 30 years of experience working with ultra high net worth individuals and families, closely held businesses, and complex tax exempt organizations. Externally, David holds various leadership and board membership positions, and internally, David is on Seiler's executive board and does a lot around leading thought leadership and mentoring young leaders. So that is David and Francis. Just to get us started here, I'd like to make sure we address sort of the genesis of this entire conversation. We are hearing a lot about people leaving California. And in fact, most of us know a neighbor, a family member, a friend who has left. And so this question of California residency is derived out of a lot of movement. We also know that personal experience is often very, very different than the quantitative 20. So I don't know if we'd like to get started, David, on just covering some of the data itself. Is there a different picture? What are you seeing?
Well, you know, Leah, it seems like every week, maybe even more than once a week, we open up the paper and we hear of a celebrity or a well-known business executive or other companies in California. Well-known companies have been in California for many, many years, talk about leaving California. So we're hearing that, and there's, I guess, anecdotal evidence that maybe people are leaving. We had a hard year last year, maybe for pandemic or for the wildfires or for our high income tax. People are looking to move, and that clearly is true. And on top of it all, we've got these sheltering in place rules, and people are finding themselves working remotely in order to develop or to maintain or to establish social ties that are important to them. Maybe they're working remotely in another state to take care of a parent during this pandemic time or whatever reason. So there's obviously, you're right, our neighbors, lots of people we see. But one of the things we're seeing with the evidence coming out, the reports are coming out. There was a really good report I recommend people to pull down from UCLA and UC Berkeley, from the University of California campuses. Early March came out with a very good report. And that report just says there's really no evidence right now of a pronounced exodus. Yes, we know of people who are looking to move for various reasons, maybe for some business reason. But the number of people leaving California historically tracks pretty closely with those who come into California. And what happened last year is that the two didn't match. Those who exited, where it was much more than those who came in, by about 128,000 people. But the question is, last year wasn't a very easy time to migrate into any state. So is that a trend, or is that just an anomaly? We don't know, but the report, and I again recommend people to look at it, spends quite a bit of time giving conclusions that there's really a little evidence that even wealthy Californians are leaving en masse. What we do know from that report is that people are moving and moving around California. So those of us, our office is in Northern California. We know San Francisco had a tremendous amount of people leaving. The exits in Q4 alone were about 31% higher than in the 19 Q4. The net exits was about 649% more from the year before, March to March. And we know that people were leaving San Francisco, but they were leaving to go to other parts of California. We know in our own history, people in the reports in the papers about people moving to the Sierra Nevadas or to other parts of the state. Yes, people are moving around. We've seen a lot of move this year in California, but again, not a lot of evidence to say that there's a mass exodus leaving. Silicon Valley has its own story because most of its migration historically has been with foreign immigrants and foreign workers, and that of course has changed. There was really a 0% change last year in Silicon Valley, and the Valley still is looking good from an employment point of view. So, and I don't know, Francis, you might want to say a few words about Southern California, but I according to the reports, maybe the idea of a mass exodus may be premature.
It's interesting, and David, yeah, we definitely agree that we don't necessarily see an exodus of California completely. We do see a lot of movement within California, perhaps away from certain metropolitan areas, as well as, within other states. So people are taking advantage of opportunities to perhaps be closer to family, or perhaps moves that but now is the perfect time to take advantage of them because employees are able to work remotely at this time.
That's fascinating. I know that sort of contradicts a lot, again, of the anecdotal evidence and experience that people are having right now. Let's move forward to another question here. Why does this all matter? California Residency, we are getting so many questions about this, and it's probably useful to make a comment that Seiler is based in the Northern California area, and GHJ is based in the Southern California area. So between the two firms, there's quite a lot of coverage. So Francis, if you wouldn't mind kind of unpacking for us, why does this all matter at this point?
Great question. And obviously we're talking about taxes today. So the real reason this matters is because in California and generally other states, residents are taxed on 100% of their income. So generally that would be their worldwide income. If other state returns are required by California residents, such as in Arizona or Colorado, then that taxpayer will receive a tax credit on their California return for other state income taxes paid. And that would prevent any double taxation to a great effect. With non-residents, if you're a non-resident of California, again, you're only taxed on your state source income. So we have this sourcing of income cheat sheet on the screen, and if you're a non-resident, that's really when these issues come into play, because if you're a California resident, obviously all of these items are going to be taxed anyways. But for a non-resident, it matters where your wages are earned. So generally where you're physically present earning your salary. Or for a business, if your activity is performed in California or other sourcing rules require you to source your business income to California. So as a non-resident, those types of income will always be sourced to California regardless of your status. There are also other issues related to things like real estate, whether that be a sale of a property or rental income. Those types of income will always be sourced to the location of the property. So for example, if you're a non-resident and you own California property, that will still have a California source. So just thinking through all of these items helps you understand that, obviously being a resident is a huge difference because all of your income is considered, but non-resident is a little bit more complex, and you're required to look at state rules, not only California, but also understanding your resident state or other state rules to determine how that will come into play.
Thanks for addressing that. And thank you for preparing this incredible cheat sheet here. I'm sure people are taking video and photos of it as we go through this webinar. Great. So at this point, I'd like to shift gears a little bit and talk about resident. The term resident. What is the legal definition of that word? We are talking about residency. The term is so integral to this entire conversation. And so what's a resident? What is a non-resident? So if we can head in that direction with our conversation, that'd be great.
California's going to look at, do you own real property in California? Are you sending children to schools here? Do you have a California driver's license? And clearly, if you live in New York and you're just going on vacation in California or passing through or signing some documents, that's not, that's transitory. That's an easy definition. But if you're taking on employment in California and you don't really have a plan to leave, even if the employment may be open-ended, may not be open-ended, I think at that point in time, you have to be pretty careful. California has a presumption of residency, and that if you're in California for more than 9 months, unless you can show otherwise, California is going to consider you a resident. And of course, there's all kinds of reasons why you could show, but that's the presumption test. And then the other test, a rule that we don't see too often, but it does come up, is that there is a safe harbor test under employment-related contracts. If you're heading out of the, let's say, out of the country or another part of the world, and you have an employment contract and you're out of the uninterrupted period for 546 days or more, that's going to qualify. There's a bunch of exceptions about how much income you have and how many days you can come back and visit. But those employment contracts are very important. There was a recent case, Leah, with the Mazer case, where the contract was just, well, he had the contract in place, but it ended and he came back too early and he lost. So worth reading that case because it's a presidential case. But the point of the matter is you do have to look at your days and how many days you're here and where you're going at. And that's how you're going to look at that. So I think we look at this transitory rule, Leah, for people coming in and people going out. So if you buy a vacation home in Nevada and you're there for a few months out of the year, but you really haven't changed your social and business connections here, likely they're going to say that's not a permanent change. That's a vacation home. It's transitory. If you live in Illinois and all of a sudden you come here and you get a new job in November of 2019, and let's say you don't move, you don't sell your house and actually move the family till the next year, California has on their website says you probably have come into California the day you had that contract, you're not planning to leave, and you're going to be a resident starting the day you come here, not necessarily when all the trappings come along with you.
So the general concepts, I think, are to your point about your connections and your intention and kind of how you're doing life within the bounds of California. Let's shift gears a little bit. And Francis, can we talk a little bit about domicile, the concept of domicile? So the two things that seem to be really important in this conversation from an income tax perspective is residency, which we just covered, and now domicile.
And you're right. I mean, we can't have a discussion about residency without also talking about domicile and how that factors into the definitions and the rules regarding residency. So the concept of domicile is generally pretty straightforward. It is your true and permanent home and the place that you intend to return when you're away for a period of time, generally for temporary or transitory purposes. And one of the presumptions that David mentioned, specifically the 6 months, less than six month presumption of non-residency, has the domicile terminology in that presumption. So essentially, what that means is you have to have a domicile outside California in order to be a non-resident of California. And that may seem straightforward, but it's very important that taxpayers understand that. And it's not just, for example, staying outside of California and ceasing connections with California, it's also making sure we set up the new connections in your new country or new state, as well as the similar connections that you may have in another domicile. So you're going to have specific things, and David referenced some of these closer connections. You're going to have these connections in your new domicile. And the other point I would like to make, and this isn't well defined in the statutes, but it's important to understand that you can't have more than one domicile at a time. So while there is a process to change some of this information and transition to your new domicile, once you have that domicile set up, then you would no longer have that domicile with California. So we've had situations where taxpayers intend to set up a domicile in another jurisdiction, but the problem is that due to business reasons or other personal reasons, they end up spending more time still in California than their new domicile. And that is one general issue that we would help and advise our clients to avoid.
So kind of bringing this back to you, David, you were talking about these different elements of your life that you establish and kind of get going in a different place to establish residency. How does the state look at all these aspects? Are each of these components that you kind of described, are they equal? Are they weighed a little bit differently?
Well, yeah, it's exactly right. They're not weighed evenly. If you went to the California website and they have a nice summary of the Bragg case, which lists all the different components of these rules. And it's very interesting read. It's a checklist of sorts, but California has made it very clear that things like selling your principal residence is probably weighted the most. And looking, I think California really, it's not just about severing connections. It's also about making new connections. So it's one thing to move, but if if they can see that you're moving your doctors to the new state, you're moving your social clubs, some other factors of your business or could be moved there, that slowly you're moving yourself and your family and how you live there. It's also about making new connections. Yeah, I have a client that said that, David, that means I can never leave California. No, that's not what I'm saying. This isn't, Hotel California, but the point of the matter is that if you are going to move, you're going to have to show that you actually have changed domicile. Domicile is not unique to California. Other countries use it. UK has a domicile rule, and it's really looking at intent. What's very interesting, Leah, though, the one thing that's in those court cases that come out is really are trying to focus on what the intent is. And sometimes it's not whether you move or not, it's when you move. Have you established enough connections in that new state to say that the move happened, on this date, which, by the way, was before that capital transaction happened, right? Or before the business was sold. They're going to argue more about the when, frankly, than the whether, because sometimes they'll just give up and say, "You're not here, you've gone." But they are looking at those factors differently. I think the California website does and they have a publication. They do a very nice job going through those. I think the court cases and the arguments assume that someone's actually gone through that list and seen that list, and you're changing your driver's license. You're changing your cell phone, you're changing where you vote. Those things are just given. They're going to look then at all the other indications of whether or not that residency or the domicile has changed.
I was kind of taking a look at things to establish residency. And Francis, if you wouldn't mind, I'd love to explore with you. Also, if you have any stories to tell about clients, it's very helpful to kind of help us wrap our minds around things. But how does someone who's leaving California make sure they're not in California anymore. They're not considered here. So sort of the opposite side of establishing residency.
Right, and great question. I think that it's obviously very facts and circumstantial for each taxpayer, but generally speaking, the first thing, as David mentioned, is, selling your principal residence or purchasing a new principal residence in your new state or country, and physically moving. So you're making a physical move as well as a clear intention in that new jurisdiction. So that would be a primary move that you can make, as well as understanding elements of your family. So a lot of the controversy in case law that we've seen includes positions as it relates to where a taxpayer's spouse or a taxpayer's children are living, or if they remain in California, for example. So it's very important to understand those dynamics because they will be heavily weighted by the state in any type of controversy decision. For keeping your physical presence outside of California, it's also very important to maintain records. So records of your daily, whether it's daily or weekly activity, making sure that you have contemporary evidence of where you are during the tax year. And also certain administrative changes, because, if you just leave your driver's license or voter registration open in California and never open that in your new state, then the FTB will document that. So if you know and have an intention of setting up a new domicile and new resident state, then we would recommend making sure that you set up those new connections in that new state, get a driver's license, make sure you're registered to vote, make sure you cancel the things that David mentioned with California, because that will help us establish any intent along with all the other factors. So again, I'm not, disregarding any other taxpayer specific issues, but those are some of the common ones that we see when we start having discussions about residency. The one thing that I did want to mention that hasn't quite come up yet is that California is a community property state. So I don't want to, go too far down this hole with community property, but because California does treat, marital situations as 50% community property, if we have a spouse, for example, that remains in California that doesn't work, there still may be some income that may be pulled back into California. So it's important to really understand the status of your new state and new domicile, if that is also a community property state or if that is a separate property state, because some of that will come into play if you have a situation where you're either married filing jointly or married filing separately, and there is a California tax return involved.
At the outset, it seems so simple just to be a resident or not be a resident, but now you're drawing into poking at a lot of different ways that our lives are interconnected geographically. I just want to make mention here, we are receiving some excellent questions here in the Q&A queue. I wanted to let everyone know that there is a large number of information here that's very situation specific. And as you can probably tell from the content and comments from Francis and David, that's going to be kind of hard to extricate and discuss here, but I'll bring some of the common trends forward when we have time at the end of our sort of prepared remarks, if you will. This record keeping thing you mentioned, Francis, can you dig into that just a little bit more and help us understand? It seems a bit of an unnatural thing to do record keeping around your daily life, but can you just sort of address how people keep records and provide them, I guess?
Mm-hmm. So we have clients, especially clients that spend time in multiple states or are planning a transition to a new resident state, that keep weekly logs or a calendar based on where they are during a period. So whether it's a week or a month, making sure that we have those records so that when we are getting ready to file a tax return, that we have that information ready and it's substantiated for our purpose. A simple Excel schedule or a calendar noting these things is good. In certain situations, we have, flight records, we have different types of documentations that are also saved with these calendars and tracking, and that is even better. There are some newer ways to actually keep logs of physical presence, such as some apps on your phone. I know of one specifically called TaxBird. I haven't used it personally, but there are some, innovative new ways for individuals to track their presence. So I would recommend just thinking through that and not, after the fact. So not 6 months down the road. Just make sure that to be aware of that when you, start transitioning your residency and keeping those records. Other types of records outside of physical presence would just be dates that certain activity was performed. For example, I mentioned, driver's license, setting that up in your new jurisdiction, or setting up your new voter registration. You can keep a personal record of when that occurred, and that would be sufficient. But the more documentation, the better. And it's a lot easier to gather that information as it is happening, rather than 2, 3, 4 years after the fact if you have a potential audit by the state of California.
Yeah, Leah, I think I'd just add, we sometimes think about that as just pre-audit documentation, especially if you're if two things are happening. You're moving to a state that has a very low income tax rate, and if you're moving on one side of a large capital transaction, those get almost audited every single time. So you almost need to stop and say, I'm going to create a file that's going to be fluid. It's going to be real time. It's going to document what's going on right now. It's not something you're going to think back 3 years from now, but you're going to show as you're going through it all. There's a recent case we're waiting to see how it's going to get decided, but the Bracamani case, which is still under consideration, they said they moved their belongings. They didn't use a moving company. Not too many people don't use a moving company, but the point of the matter is they couldn't show a moving company record of that they actually moved their things. That seems kind of silly, but that is a record that would be normal that you would have, and likely you would probably keep something. If you do have those records, it's really important to start assembling information so you can defend yourself during this transition.
You brought up the topic of audits, and I'd like to address that in a couple of minutes here, but something that we'd like to just touch on is, does it matter where you're moving to? We've talked about people moving within California, which is one thing, moving outside of California to another US state, or even moving outside of the United States altogether. Do you guys mind kind of exploring with me, and for the benefit of everyone, just does it matter where you're going to?
I will just say that there is a California auditor that actually told me if you're leaving the country, they're going to scrutinize that more, frankly, because they're not sure. Now I have a client that's moved to Asia, and it's going to be a 2-year stint. I don't think they'll meet the 546-day rule. Clearly, they're not going to win that one. And I have another client who's going through an exit process right now with the federal government, and he's giving up his citizenship. I would hope that works. but California has said if you're moving out of the country, they're really going to scrutinize that, because oftentimes people do not change their domicile on these international moves. I don't know, Francis, have you seen something different on that? That's what I'm hearing and seeing.
I mean, I would agree. And I think that in terms of moving between different states, we find that there is more attention to no tax states such as Texas, Nevada, Florida. It's, it's not necessarily with everyday taxpayers. As David mentioned, it's usually when there is a significant amount of federal income on a non-resident return, perhaps a first-year non-resident return, and a very limited amount of that income is sourced to California. So it's important to really just understand the dynamics and in your facts and situations to make sure especially if you're trying to move to one of those jurisdictions, or as David mentioned, internationally, that you have the records to indicate that your domicile has in fact changed.
It's quite a lot of questions we're getting on a number of things. Again, thank you everyone for submitting these, and I will do my best to summarize some key themes for us to explore. Before we head to Q&A, I have a couple of really big questions for you guys. One, let's talk about audits. California state, how aggressive is it? What are you seeing with your clients and the court cases? And the second thing we really want to make sure we address is remote working situations. That is one of the biggest changes that we've experienced, and by all accounts, it's not going to lessen up. It may only accelerate in years following 2020. So just making sure we'll bookmark that and make sure we get to it. But first, let's talk about audits. Not everyone's favorite subject, but definitely something that we need to know about.
Well, I guess I'll start, Francis. Yes, California is aggressive. California won't give up, and they are looking at transactions. They're looking at, if this is where, Leah, there's misconceptions. I had a client that said, I heard from a wealth manager in San Francisco, if I leave out of the state, sell my business, and 1 year later come back, I don't have to pay gain on that. I said, well, that's just wrong. I mean, that's just clearly not following the California rules on that. And California is looking at things. They're looking at, especially if you have, as Francis said, a large federal capital transaction, capital gain, or something going on your return. And California is really brilliant at not just looking at tax filings. They're looking at non-tax filings. They're looking at lots of connections. One of the things that I think is very interesting with both the state and the federal government is they're starting to use AI. They're starting to use a sophisticated way to look at data. And they may not pull you for an examination for another couple of years, but they're very anxious about this, and they are trying to close that loophole. And so I think the key is just making sure you have that documentation. Hindsight is difficult to establish sometimes what really happened. So it's really important to, and these court cases seem to say that, you can't just all of a sudden try pulling together your documents. You really need to show that there was a clean transaction going on. Francis, what are you seeing in our audits?
Yeah, I would definitely agree that California is very aggressive. And it's important to understand that while we suggest keeping travel logs and records, the state will go much further in an audit. They will ask for detailed bank transactions. They will look at your credit card receipts. They may look at, where you're picking up an Uber, or where you're getting your Amazon packages. So it's not something that you can have this travel record and it may or may not be correct. The FTB will go through a process to make sure and validate through other contemporary records that is in fact where you were at that time. So it is, a very detailed process in an audit. It's something that you should be prepared for in any event, because again, it's much harder to pull that information together 2 or 3 years later than it is at the time. A couple of the different situations that we had mentioned of recent cases and specifically precedential cases that have come out. David mentioned the Mazer case, which unfortunately was not determined in the taxpayer's favor. And that was because the taxpayer's employment contract in an international country, specifically Malaysia, was just over a year. So it wasn't within that extended period that would allow any relief from California taxes. There was another case, specifically the Khan opinion, that was decided, and this was related to tax year 2013 as well. In this case, the taxpayer moved to Saudi Arabia specifically for religious reasons, but the taxpayer's wife and children remained in California. So in this situation, the marriage was fractured and there were divorce proceedings filed. The taxpayer did obtain employment in Saudi Arabia and ultimately did not return to California as part of this case review. In this recent decision, just a few months ago, this actually was decided in the taxpayer's favor, and they were deemed a non-resident for 2013. So it is interesting to compare and contrast these different cases. But what we found is a lot of the FTB's reasoning and arguments in these cases rely on what the taxpayer does in the future. So it's important to also understand your intent, 2-3 years down the road, if there is a chance you'll come back to California as well.
Do you have any examples of also misconceptions? It's a little hard when you are a taxpayer trying to seek out the best advice, and maybe you have two different advisors that are saying different things. Do you have any other common misperceptions that you're working to correct for your clients?
Well, I think, Leah, you just have to be careful not to play a game. So some of the cases, examples are, yeah, you created a new cell phone, but you never got rid of the old one, and you're kind of hiding the old one. You establish a new mailing residence, new, primary residence for mailing in the other state. But all your mail's forwarded to California. That doesn't look too good, So there's a I almost every week I receive a call saying I've heard. In fact, I just received one this past weekend. I heard that if I just stay out of California for 6 months, I won't be a resident. And I said, no, that's not true. Give me a call, please. So there's lots of those misconceptions out there. I think the key really is to understand domicile. California kinds of thinks domicile as, if you're a California resident, Leah, why would you ever leave? So their view is, if you're here, you're going to want to live here forever. And that may not be the case. You really have to show that your connections have actually changed.
Yeah, I think one more misconception I want to reiterate is the concept of source income. So one of the items that's come up both in controversy and that we've seen a lot with our clients are things like installment sales or other types of income that, even if a portion of that income is received in a future tax year, that the taxpayers may not realize that it is all still California source if the transaction, the initial transaction date indicated that it was California source at that time. So it's important to not think that we can, postpone payments or structure a transaction in a unique way, because it may not help in terms of reducing your California tax liability.
Lee, I think also sometimes people think it's, if you're selling a business, it's when the escrow closes where you are. California looks at when the escrow opened. When was the deal consummated? When were you talking about it? They're going to look more at those things than actually when the whole transaction closes. Now, they may be right or wrong on that, but that's how they're going to initially come to the audit, and they're winning on those things because they can show, well, there was a letter of intent, or there was negotiations going on that prior to the move, and they're going to say that happened prior to the change of residency.
I thank you for addressing some of the intersection questions between business and personal. There are a lot of business owners out there and people who are involved with transactions and deals. And that is actually, frankly, a lot of the questions that we're getting have to do with those things, the sale of certain properties and assets, moving businesses as well. So before we lose too much more time on the clock, I really want to make sure we attack the question of remote workers. And this is a brand new subject. Francis, I don't know if you want to sort of kickstart some thoughts and some comments.
Sure. So when we talk about remote working, it's interesting because of the COVID dynamic and the fact that a lot of employers have either required or recommended that employees work remotely for the past year. Something that often isn't considered or thought through is having a discussion with your employer. So when we have an employee that's working, for example, normally from California, but maybe they are now working from Hawaii or now working from Arizona, technically those wages that are earned in the different state should be sourced to those states for your individual tax purposes. And the issue that I'm kind of pointing out here is that if the employer is not aware that the employee is working in those other jurisdictions, then the proper withholding usually will not be done in those other states. And, you know, depending on how that sorts out, the individual will still be responsible, you know, for paying that tax at the appropriate time when a tax return is filed. It also creates other issues for the employer because there could be other, you know, state tax nexus issues for the business entity that they're working for. So that's kind of another conversation, but it is very important to understand that wages that you earn in other states, regardless of your resident state, are still subject to tax. And sorting through that can be a little bit complicated. But again, as I mentioned earlier in this discussion, if you do file non-resident tax returns and pay tax in those jurisdictions, ultimately you should get a tax credit on your resident state return, such as in California. So there's really not much double taxation here. It's just a matter of making sure you're compliant and understand the rules.
Yeah, Leah, I think it just adds complexity. And in some of these states, on the East Coast especially, those states require those employers to withhold in that state, irregardless of where the worker is. And so we have different rules in different states. And yes, it's possible that in the end, the employee is going to even up in the end, but it adds a lot of complexity to the returns. And there is, and yes, it's a dynamic situation. All of our associations are begging the federal government to step in. The AICPA specifically continues to ask for guidance. And there is a case that has not been chosen yet, but is being considered to be chosen by the Supreme Court, the Massachusetts case, which they're asking the Supreme Court to decide, in this case, it's the other states around Massachusetts, whether or not those Massachusetts laws are legitimate. And it's difficult because we have public laws related to how states handle their own tax situations. They generally have a lot of discretion in what they do. But in this case, it creates a lot of difficulty. So if you have an employee that normally lives in New York, works for a New York employer, and finds himself in California last year, maybe to help to watch over a family member or parent, and decides to work remotely, California, that's a non-resident. So that person's going to be viewed by California as likely going to need to file a return. And maybe they don't have withholding, they're going to have to do a credit. There's going to be some penalties probably, but in any event, they're going to need to file. However, if you have an employee that's a resident of the state and employers in California, and even if it's not in California, the governor in California have issued, because of the pandemic, residents we might give some discretion to. But that ruling that came out, that notice, did not mention non-residents. So we're very concerned about how California will apply these rules. 43% of Americans worked remotely last year, according to the statistics, which I thought it would be higher than that. Many of those worked outside of the state that they normally worked in. They're working from home or from some other place. So this is interesting to see where this will go. So far, California hasn't given any more guidance. And I think that's the position we would probably take, Francis, if that came up, unless guidance is given soon.
A lot of questions remaining. Speaking of questions, I'd like to shift gears a little bit and kind of highlight some of the themes that we're seeing in the Q&A, and give you, Francis and David, a chance to kind of pick up on these or save them to discuss later should people want to reach out later Again, just a reminder to everyone on this webinar, we will be displaying Francis's and David's contact information later. So if you have a question and you'd like to consult with them, you'll be able to do so. Speculative or future looking types of questions I think are very important right now. What are we seeing with respect to how the new tax reforms will affect California income tax? There's a lot of stuff in the news this week about potential reform on a federal level. We have a lot of questions about specific sales in California or another state, moving from California to other states. There are a lot of questions like that, but I think it'd be helpful just to kind of look forward a little bit. Exit tax, that was a question also asked a little bit, if we could address that. And then finally, another theme is RSUs, ISO stock options, a bunch of other income types. And if there's anything that we could point to that would help untangle some of those income sources so people can think more clearly about them. So that's a lot. I don't know if we have anything more time than for you guys to pick up one question each or something like that. David, would you like to kind of get us started?
Well, I think I'll just start off by saying the question about where we're going. Obviously, at the federal level, there's been a lot of COVID relief bills. Oh my goodness, this past year we've had just a plethora of bills. We've had one in December, one this year, and there's talks of another $3 trillion something that might come out in the next little bit. We'll see. California has had a little bit of a hard time really giving a lot of changing their laws to comply with those rules. There's been a few things, and some of them have been put on hold because they're trying to find out a little more guidance from the federal government on whether or not, whether some of those federal rules require states not to lower their tax rates. So the governor just came out about 2 weeks ago with an announcement. Until there's further guidance from the feds and from Congress, they're really not going to be able to do much more at this time, which is unfortunate. We would love to get some guidance on the remote worker area. I think that eventually there will be some guidance on that. I hope, but as for generally with respect to tagging the federal laws, we've seen very little of it, and we don't have time to go through what we have seen, but I think we've all wished there was more.
I can try to address a couple of the different questions related to having a home in California. So there's one question which I will address first that has to do with, for example, selling a home or property in California and how California would treat that gain. For example, if at the time you sold the property, you were a resident of another state. So with things like real estate and property, when we look to the source of that gain, it is where the property is located. So generally speaking, even if you are a non-resident of California, if you sold your home in California, absent any other, tax exclusions and things like that, you would report that gain, whatever's taxable, as California source based on the location. There were a couple other questions that related to being able to keep a home in California and how that would impact your residency if you were trying to set up a new resident state and new domicile. And, that's an interesting question. And it really just depends on the dynamics of the situation. If you do intend to keep a home or property in California, a lot of times we recommend that our clients consider renting it out. So maybe leasing the property or using it as for a different purpose rather than a second home. Because if you still spend substantial time in that property and have access to that property on a regular basis, then that could be, a real determinant or contributing factor to having actually set up a new domicile in a different state. So it's really important to just understand if you want to keep that home, what you're willing to do to kind of set up your new domicile. Because, if you still have one home in California and you rent an apartment in another state, the optics are one thing. But if you have one home in California and maybe you have 2 or 3 homes in your new state, then that might look a little bit different. So it's really just depends on the specific situation and being able to control the factors that set up your new domicile.
And Leah, don't forget, where are the pets? Where's the dog? Which home has a dog in it, or a cat, or whatever it is, the fish?
So elaborate on that, David.
Well, we laugh at those things, but those things are actually in some of these court records. It's, you know, I have a client that left last year during the wildfires, and her comment to me was, now she had lots of animals. I won't go into that, but she said all the animals left in August of 2020, and we've never come back, and her house is up for sale right now. Now, I'm pretty confident that she's going to be able to argue she changed her residence, she moved to Arizona, or wherever she's moving to. But when she tells me her moving records show that not only she moved, but all these other belongings moved, those are the great fact situations.
So the pets and where they live also matters. What's kind of a funny point to be concluding on. And speaking of conclusions, it is time for us to start wrapping up. Again, I just want to remind everyone, there are a lot of really specific questions about the sequence of transactions in order to establish new domicile and to work around your tax situation. Do be in contact. It is a more complex year, and we have seen so many questions from so many people. We've also seen advisors inundated more than ever this year with very complex questions. So be in communication early with your advisors, and be thoughtful and thinking ahead, as hard as that is to do during this time. I'd like to share with you just the contact information for both Francis and David here in the next slide, but also Francis, David, can you leave us with one or two things you really want people to take away from today's presentation?
Well, yeah, I think I just recommend people to get good counsel and to think through before the move what your intentions are. What are the family's intentions? Yes, you can move out of California. You can move out of California, you know, before a sale is consummated within reason. And the key is planning. The key is making sure you have looked at all of the implications, the facts, and structure the family move or the company move or whatever it is in the most tax advantageous way. I think I just leave it there to start talking about it with your advisors, you know, well before the move ever happens.
Francis, you get the final word for today.
Yeah, and I would just add that it's important to really understand what you're willing to do as well. So as David mentioned, you know, get your advisor, be thoughtful about it, plan in advance. But also, you know, think about what makes sense for you and your family, and timing wise, because it is a significant change. It's a life change. It's not only a tax change. So consult your advisors, get good expertise, and make a decision that works for you.
Thank you so much, Francis, David, for your expertise and your time today. Thank you, everyone who's joined us. We had over 150 people on our call today. We are going to conclude our webinar right now and wish you a wonderful rest of your day. Thank you so much.